Good evening, everybody. Thank you for joining. If you are yawning, I feel it. We are working a long day. We are still at the office here in Old Town Torrance, and it's been a great day. Started with a 7:30 breakfast at Rudy's. If you've ever been to Old Town, let's go to Rudy's. It's an awesome breakfast spot. Uh, but we really appreciate everybody joining. I think today what we're going to cover is a lot of different things. I'm going to try to go through this in a concise 45 minutes to a power hour. And if this is of interest to you, or if you have any questions, let's save them for offline. The whole point of this is to be thought-provoking, share some stories, let you know that you can do this too, and basically give you some fundamentals. So let's go through today's plan. So tonight, we're going to cover your real estate team and who are we? Maybe we could be a part of your real estate team. Maybe you're already working on a real estate team, or maybe you're even working on being an agent or a real estate agent as a part of our team. I think we're going to cover a couple other things as far as let's create your own investment plan. Let's look at some recent data. We have some data from 2025 that looks very interesting. And we'll try to play both sides of that equation. We'll let you guys decide where the data falls, but we'll present it. We'll look at some financing options. What type of financing models can we use in today's market? Both from 2 to 4 units, and also we'll look at some 5 and ups. Investing strategies. Everyone has a different strategy. So we're going to cover some strategies that we feel are worth your time, but there's a million of them. So we might not cover all a million tonight. We're going to define maybe your buy box. Everyone has a different buy box or a different re-leverage box. We're going to look at some of examples of how that may pertain to you. And then if we have time, we'll cover a quick deal analysis as far as what we feel is a good deal on the market that actually kind of goes both ways, either entry level, maybe you're living there, or entry level, this is your first 2 to 4 unit. So with that, let's move on into our first action item. Step 1, let's build the team. Highly suggest you work with someone that you trust. I think that there's a lot of different type of realtors, real estate agents, brokers out in the marketplace. There's a million of them. And I think that if you're doing a long-term investment plan, I think it's worthy to work with a team that has those in mind. So I think a couple things are planning are big. Let's just not buy the property and then worry about the planning later. Let's plan before we buy the property. It may seem very simple, maybe underrated, but man, it is really important. What are we buying and why are we buying it? Are we just buying this one property to hold on forever, or are we scaling? And what does that scale look like? Maybe work with a local team. South Bay's best 3-time winner. Maybe, I don't know, just a shameless shout there. But I think it's important to work with some local individuals that also own. I can't tell you how many real estate brokers I talk to on a daily basis, and they sell a product, but they never participate in the product that they sell. I find that to be very interesting. And so these are just a couple clips of what Chrissy and I own. And it's a diverse. We have some single family, some multifamily, some industrial. So for today, we're going to cover mainly just multifamily. And I think the reason that multifamily stands out for us in Buckingham's 60+ year tradition is it's a basic human need. It's scalable. You can really achieve a lot of different goals, a lot of different investment strategies within it. So Buckingham, believe it or not, has been doing this since the 60s. And we have a lot of different metrics. I'll let the metrics lie and we could talk about those later. But I think it's really cool to be a part of a company that's been around that long and has been through a lot of different cycles. I don't think a lot of other brokerages can speak to that. Um, so that's obviously who we are as a real estate brokerage, but find your own brokerage. Maybe this applies to you out of state. We can't help you out of state, but find the same type of template, the same type of format for those individuals. Maybe this is, I don't know, up in Sacramento, even though I've done deals up there. Maybe you find a local team that, strikes you better. But I think trying to build that team is important. A couple other things that at least we feel is important is when we're buying these, basic human needs, there's a necessity to have contractors. There's a necessity to have a good lender. Believe it or not, the lending is the biggest piece to your strategy, both in purchase and in scale. So I wouldn't recommend just finding someone off of, I don't know, Yelp or someone online. Find someone that knows what they're doing, that is a full-time lender. I can't tell you how many deals we've been a part of that fall apart. And we have really solid lenders that we work with and we recommend, but sometimes people want to work with their own, and that's okay. But make sure that they're as invested in doing a good job as you're as invested in buying a good property. Property management, that's another critical piece. If you are not going to self-manage, I recommend it. Chrissy and I are partners here at Buckingham, and we always have this internal debate here on whether we should self-manage or hand it over to a professional. And I think there's a camp on either side where if this is not your bread and butter and you don't want to have that first contact point with the tenant, or you just are working your day job and you have no time for this, then definitely get professional property management that knows the area and can do a good job for you. But maybe if you're like me and some others out there that you want to roll up your sleeve and you don't mind having first contact with tenants and getting involved, I think self-management is a good place to start, at least. But maybe maintaining that is something you can consider. And then inspectors. You want to buy a good building, but we got to make sure it is a good building. So other things that didn't make this graphic here that I would consider are a good CPA. An accountant and CPA are a really good duo, especially for today's world, understanding the tax benefits. We're not going to be a CPA today, but understanding the tax benefits or the tax incentives to doing this is really important, especially maybe with the more recent legislation that has been passed. So I think when you are trying to achieve something that I think is lifelong, something that can be really impactful for your family, I think you start here. Don't go on Zillow. I know it's tempting. Don't go on CoStar or LoopNet rather, and start trying to buy that property before putting this team together. I highly suggest put the team together first and then go at it. Go bonanza at looking at properties, and there's plenty of them to look out there. So I think that's a really good place to start. And I also think it's a good place to consider as far as what is the team not doing? In this world of AI and all these different brokers trying to achieve AI and create a fake person. This is real. I promise this is all real behind us. They're trying to create an avatar, and the avatar is doing all the work, or you're talking to a robot and you're like, hey, is it real or is it not? Like, let's figure out who we're not, because I think it's really important to work with people that can define who they're not. They're not the jack of all trades. They're the master of one thing. And so I think this is a funny list, but man, I think it's really relevant in today's world. So Buckingham Investments may sound like we are a crowd fund or some equity firm. We're not. We are a real estate brokerage. We do real estate brokerage, and that's it. And we love it. We are not leasing agents. We handle sales. We work with buyers who are buying, sellers who are selling, and in between people who are doing exchanges where they are a seller and then they become a buyer. We will not be leasing your retail space or your units. We have professional property management referrals, that we can recommend for that. We are not short-term operators. I think that's a strategy that may work for some. And I'm not knocking the strategy, but man, there is there's a lot that goes into it, and that's not what we do. We are long-term rental operators, and we could speak to that for days, but we'll try to keep it to the power hour today. Um, some of us, I'm looking at you, Chrissy, are not property managers. I happen to manage my own building. So there's, again, back to the divide there. I think we can fill either camp there, but that's not our primary business model. This may seem like this is creating content, but we do this for free. Chrissy and I are taking our time. We are not content creators. We are not getting paid by, I sound old, but X or YouTube or Instagram. We're not getting any of these checks that maybe other people are in our space. We're just doing this to help you guys. And we're also doing this to share our stories, because I feel like the more times we share a story, it's like someone can resonate and they really need just a genuine person that they want to talk to or can connect with. We're not part-time agents. I know a lot of your uncles or your aunts or maybe your wives or your friends' wives or friends' husband or whatever the case may be. They do it on the side. And that's great. That has a place for some people, but that's not us. We're full-time, been in the office, like I said earlier, all day, and we'll clock in another all-day office day tomorrow. But if you're spending, I mean, this could be the biggest purchase or biggest series of purchases in your life. I think you work with someone full-time like you would in any other part of the world that you're trying to work with, a CPA or an attorney or whatever the case may be. We're not stockbrokers, so we're not going to give stock advice. I think stocks and things like that have their place. I also think there is a time to maybe consider getting out of the stock market or diversifying, but we'll just leave it at that. And we're not going to be your real estate guru. So if you're expecting a $20,000 mastermind course sale at the end of this, I apologize. You're not getting it. So we're just going to be normal people with a laptop. And my team gave me a new camera. If you were here on our last series, I now have a new camera. But we're just normal people with laptops and cameras, and happy to share our story and help. So this is why we do this. I think part of step one, at least for me personally, and I know for Chrissy as well, is not only are you building your team, are you also figuring out what asset class you're looking at, maybe what corner of the market you want to play in or invest in. But I think a lot of it starts with why. And so we won't go down the family sob story, but I think this is extremely important to consider. Why are we doing this? Everyone has a different why. And luckily, Chrissy and I align here on our whys. We're doing this for our family. And so Chrissy and her lovely family, and myself, my wife, and my 3 girls, our dogs didn't make the photo. But this is the why. And this is the why my family's been doing this. My family's been doing this since I was a kid. My mom and my dad were buying local apartments here in the South Bay, predominantly Redondo Beach, before Redondo Beach got cool. And I was right around, I don't know if the cursor is showing, but I was right around this age, my oldest daughter's age. And I was helping my dad fix some fences, mowing the lawn. And my daughters get to share with me on my experiences now too. So it's kind of cool to live that legacy. It's not for everybody. I know some people's why is just a big bag of cash, and that's awesome. I support that. But I think it's important to share. If you intend on working with us, or if you intend on doing this yourself, figure out your why, because there's going to be times where you're like, man, this is tough. And if you don't have a solid why, I just think, I think there's a little bit of a lack there. So enough of the family and the sob stories. We could just kind of jump right into basic 101. That's why we're here. So why does this work? Or another way to look at this is, how does this work? If we have this team put together, we have our why figured out, now let's look at the kind of how or the what. And you probably have all seen this, so this may be, some repetition here, but I think it's really important. If I'm building this house or this legacy, what's the foundation? What does this thing look like? And this is the foundation. This is time value of money, compound interest. Very simple to understand, but very impactful for people on a daily basis. So we'll go through it. Future value is equal to your present value times 1 plus your rate of return, which is your R, to the power of n. And we have this silly little drawing here where your number of years is on the bottom axis and your net worth, return on equity, whatever we're quantifying is on this axis here. And it starts out a little low and slow. I'm a barbecue guy, so if there's some references of food here, forgive me. But we're going to go low and slow on that brisket. And right at the end, you get up to temp, and man, you got some really good eating for that day. But same thing here. It just takes 20 to 25 years, not 20 hours and a smoker. So this is a really good place to start, and we never shy away from it. And it starts with your plan. If I understand these variables, now I can manipulate them a little bit. Okay. And it's very simple. I know, gloss over, oh my gosh, but put this up on your window, your chart, your dream board, whatever it is, and make it real. I'm going to invest present value dollars for N years at a sustained rate of return of R% and be worth future value dollars at the end of the plan. So let's kind of talk about that. Your present value is a couple things. It is your down payment, your closing costs. Maybe there's a potential rehab budget we got to account for. Definitely have some reserves, things like that. That's going to be your present value. Where does that come from? Well, a couple things to consider. Cash is king, right? But we all don't have the money tree in the backyard. So consider other things, maybe a partnership. A lot of people start with a simple friends, family, whatever it may be, 2, 3 partners, pool some money together, diversify the risk. That's present value dollars. Maybe it's you've owned your home for a long time. We work with a lot of individuals that have a really good equity position in their home, and they either refinance that and pull some cash out, which is tax-free, or they really like that interest rate. Hold on to that 3%. I still have one. Hold on to that 3% interest rate that we'll never see again, and pull a HELOC against that. A little bit higher in interest rate, we could talk about that. But my point is, present value dollars doesn't always have to be just a bag of cash, and it doesn't always have to be one individual. So stuff to think about when we're looking at present value dollars. So other variables that we get to manipulate as your broker team or whatever team that you're working with, I think it's really important to sustain a high rate of return, and we'll talk about that. And how long are we sustaining that high rate of return? That's the team helping you, right? So you figure out where the present value dollars are coming from. We'll work together. You work together with your team on how long we're holding them in this plan. What are the sustained rates of returns? How do we achieve those, right? And then you get to have fun with the future value. What is that future value? Is it the family? Is it getting all my daughters through weddings? I think I have to pay for those. That's I think what I'm supposed to do, right? Colleges. These things aren't cheap. And I'm not just going to wake up one day and it's like, oh man, let's start writing checks. Let's plan for it now, right? So anyway, I could go on for days about the future value and have some fun with it, but make it real. I think is really important. And some people do and some people don't. That's okay. So when we take these variables, I think it's hard to imagine this big abstract thing. The equations make sense, fine. But like, what does that really mean, right? Put some graphs, put some numbers behind that. I'm a visual guy, and I think a lot of people are these days. So this doesn't mean it represents you, okay? This doesn't even represent Chrissy or I. We're all different. But let's give it some sort of benchmark or some sort of base. And so our starting value is our present value, okay? And maybe it's 200,000, maybe it's more, maybe it's less. Who cares? But that's just our benchmark. Number of years, we got to do this long term. Okay, we can talk about short-term strategies, but for today, let's focus on long-term. Return on equity. A lot of different people are going to look at, ROIs, ROEs. We can get as many, crazy acronyms as we want. But I think the return on equity is the easiest, but also what is the most encompassing return when we're looking at one property or a whole portfolio of properties. So being the graph people and the data nerds that we are, we kind of chunked it out into a 5% return on equity, That may stand true to you. I know it did to my family. My family started buying property, like I said, when I was a kid, and debt was bad back in the days. And so it was trying to save up money, pool a partnership together or two, and let's buy this thing all cash. And that may be true to you. That may be your return on equity. And I think that's great. Maybe we add a little bit of leverage. Maybe we take a little bit of a riskier strategy. Now we can get somewhere in the 15% return on equity. And these numbers are very real. We're not just pulling these out of a fictitious book. These are what our clients have experienced over the last 60 years. And this is how the math works. In year one in 2025, if we were to assume we started last year, right, and we move on into year 2049, it's crazy to say that, right, you're going to be worth $200,000 to $6.5 million. And we'll talk about how you sustain it. You can't just buy one property and it turns into that. Okay. So there is some legwork. It's not just low and slow, back to the analogy, put in the smoker and never see it. You got to spray it a little bit. You got to put some butter on it, right? Some time, whatever. So we got to put some work into this thing. But if these returns are a little too low for you, hey, let's get riskier. And this is the return profile for me and my family is let's do some value adding, some fix and flip. ADUs, very popular, great way to achieve a higher return on equity into this 30% bucket. And again, it just gets really, really powerful when we're holding this for long term. You may be slamming your head against the wall the first couple of years, and then man, it just goes parabolic and exponential, and you turn $200,000 turning doors into $141 million. Okay, this is not fictitious math. This is very real, but you got to stick with it. It can't be one property. It has to be a series of properties to achieve these kind of rates of returns. This is another way to look at it. Same equation. Okay. Some people like graphs, other people like charts. So I'll walk you through it real quick. We have present value dollars on this side, on your left-hand side with chunks of 50 all the way to 300,000. We have number of years. This will be your N component, 10, 15, and 20 per chunk. We have return on equities. This would be your R, 20, 25, and 30. And then the matrix in the middle is going to be your future dollars. So if that number didn't speak to you, maybe the 50,000 does, or maybe higher, right? But everyone has a place, I think, in this investment journey. And these future value dollars are very real. And these rate of returns are also very real when we consider all four elements of return, which we'll talk about here in a second. Okay, moving on. I think it's important to consider you can't just buy one property, okay? And I know if that plan is for you, I want to buy that one property. I want to pay off that 30-year note. If I'm buying a residential property, it's really important for me to just pay that debt off. And then, I'll be in the money, or that'll be the family strategy. I think it's great. Nothing wrong with that. I think also when we consider buying cash, there's nothing wrong with that as well. But let's maybe play this out, and I'll let you guys decide. So in one example, we take this $200,000 and we do a cash purchase. Okay. Now you may laugh. You're like, Matt, where in California are we doing that? I know. Just bear with me here. Okay. That's maybe a garage, but it speaks to the number. So let's play it out here for a second. Okay. We'll talk about local rates of appreciation here in a second, but let's just assume in Southern California, 5% is a safe number, which it totally is. Okay. So let's walk down the path of, let's do a simple return on equity calculation. I buy it for $200,000. All I'm looking at is appreciation. Let's say it's breaking even on cash flow. Let's say there's some tax shelter benefits at play. Other things are at play behind the scenes, but we're in Southern California. We have a really good appreciation market. So let's consider it. So $200,000, year one return, 5% on $200,000 is $10,000 in equity. All right. Return on equity is your $10,000 of return over your initial equity position, which in this case is your cash purchase. Surprise, surprise, your 5% return matches your appreciation. That's great. Again, my family was doing this. This is how I learned as a kid. Okay. And this is what was important to my family. And later on, my family's opinion changed. And my wife and I, we're not buying things cash. We're doing maximum leverage, which we'll talk about. We're doing FHA loans potentially, or we're putting 5 or 10% down. But again, there's a strategy for everybody here. So let's walk down the same path. Okay. We take this $200,000 and instead of buying a garage all cash, okay, in Southern California, let's buy a piece of property that's worth $800,000. That's doable. Okay. That's probably going to be a duplex. So if we buy this $800,000 property, we put $200,000 down, we get a loan, other people's money, for $600,000, and we're in the same market that's appreciating at 5%. Okay. Year one's return on equity is going to be the 5% of our $800,000. Our appreciation rate is on the property's value. Okay. So 5% of 800,000 is 40K in appreciation dollars. Very real, by the way. This is not guesswork. This is calculated. Return on equity would then be our 40K divided by our initial investment, our initial equity position. And now we take a similar $200,000 investment and we go from a 5% return to a 20% return on equity. Okay. Now, going back to these graphs, I can't achieve this types of graphs with just buying one property. Okay. And this is what this is trying to explain is if I go now into year two, same market, that property is now worth $840,000. It's still appreciating at 5%. I now have $42,000 in equity dollars in year two. And my return on equity is that $42,000 in equity divided by my $240,000 in my equity position total. So it's diluting. My 20% leverage returns is now in year two, 17.5%. We play that out. Now we have year three. It's now worth 882, appreciating at 5%. I take my 44K divided by my total equity position. My return on equity is 282. Now it's down to 15.6. So what's happening is, it's a good thing, by the way. You're making money, more money each year as your equity continues to pile in. Okay. But over a percentage basis, you're diluting your percentage, which is okay. It's not a bad thing. But I think if we want to achieve what I was talking about, liftoff on the graphs, I think we have to do something. And this is where everyone's going to be different. Some people will achieve this in year three. Some people will want to achieve this down the road. But whatever year this is, year X, we'll call it, and we're just speculating what this may be for you, but the property will continue to go up in value. So let's play it out. It's now worth $1.2 million. Okay. And we take the $600,000. Okay. We put that in with a loan. We're still appreciating at 5%, right? And those $600,000 maybe came from the initial re-leverage strategy. This could have been a sale. This could have been a refinance. We put it to work again. And we are now getting 5% on $1.2 million, which is 60K. Okay. And our return on equity then is 60K divided by, again, our year one equity position when we did the re-leverage strategy. Okay. And we're now down to 10%. Oh, sorry. I got ahead of myself here. We're diluted down to 10%. And I got the exchange. This is new technology, guys. I know. I'm trying to keep up with the technology here. So that would be a diluted down to 10. The re-leverage strategy I was talking about would bring it back up to 20%. Okay. We take the 600K that we made as a down payment. We buy a bigger property worth 1.8. Sorry, loan of 1.8, 2.4 million is the property's value, appreciating at 5%. Okay. And the strategy is re-leveraged. We're just putting the money back to work. And I apologize. My screen on my end is a little bit different than it is on yours. And I'm still learning how to do this. So like I said, just normal people over here. But the re-leverage strategy works. So let's talk about how can we re-leverage? Okay. Refinance and rebuy. Okay. Take that 4-unit, that duplex, whatever it is. Over years, it's worth more. Pull that money out, which is tax-free, and put it to work as a down payment somewhere else. Okay. Or we can sell that property. Okay. And we can do an exchange. Again, another tax deferred strategy. okay, that we could take that equity and put it back to work. We call it lazy equity when we're getting down into this 10% bucket. It's not working as hard for you. Some people, maybe they want to pay off that note. I get it. But if you're like me and we're aggressively growing, okay, I think it's time to maybe reconsider what we can do with that. So those are just a couple ideas of how we need to continue to sustain a rate of return. When we look at that R variable, okay, it's not just a rate of return, it's sustaining it. And I think it's important to consider what that looks like. So again, laughing here, I tried to draw this and you're just going to have to forgive my technology here. But drawing this out, okay, I could let this play out where if this is my return profile on this axis, 20 to 5 is our numbers here. I know it's stick figure, get over it. And I have my years on this axis. Just over time, I'm paying it off. There's nothing wrong with that. Your cash flow is increasing, okay, but your return on equity is decreasing. So another strategy to consider. If we want to sustain a high rate of return, okay, then we're going to play a little bit of the re-leverage game where we're going to start high. Our x-axis is our return. Our y is our time. We're going to start high on the first year of return, like we're talking about at 20. And over time, it's going to dilute. We re-leverage. Trying to double our doors is what we'll call it internally. Okay, so we take this 2 unit, turn it into 4 units. Turn this 4 unit, turn it into 8 units. Okay, take this 8 unit, now it's diluted, turn it into 16 units. Okay, and it's very real. It just takes time. And it takes a team that is monitoring these returns and also looking out for your best interest. It's not always good to sell. I totally firmly believe as a broker, as potentially your broker, don't sell. Try to hold on to everything. That's the game of Monopoly, right? Is try to hold on to everything. Try to re-leverage through a refinance. Okay. Try to re-leverage through adding value, maybe as an ADU, or taking your rents from $500 a month to $1,000 a month. So try holding that property and re-leveraging that way is my firm suggestion. But the point is, if we're trying to sustain X rate of returns over a long series of time, we have to do some work and we have to continue buying. And I think the best way to think about this is Marty Stone and Jack Buckingham are who founded Buckingham Investments. Okay. Marty Stone is still around and he wrote a really good book. It's long, but it's the unofficial guide to real estate investing. And he characterized this type of strategy as kind of phase 1, phase 2, phase 3. So phase 1 is you buy in maybe C parts of town, not the best parts of town, but they have a higher return profile. And you start with a lot of leverage. Okay. Maybe you're putting 5, 10% down, whatever the case may be. And let's say this plan's 30 years, this hypothetical plan. So the first 10 years, I'm stacking small doors with a lot of debt. Okay. And phase 2 is I'm now trading into a B part of town, better part of town. And I'm doing, instead of maybe 10% down or 20% down, I'm now doing 50% down, less debt, a little bit safer. And I'm also in a better part of town, better building quality. Okay. So that's phase 2 for the next 10 years. And then phase 3 would be the last 10 years where you take all of these B area assets with maybe 50% debt on them and you trade them into 1 or 2 big trophy assets. And in an A area with little to no debt. And usually that's the time that you also want to take less risk. And that's also the time that you need or are going to start relying on the cash flow that you've accumulated over time. Because the end of the game is stack doors, do this for your family, but also I'm deferring my cash flow to a later date when I'm doing that. It would be nice to live off cash flow now, but I don't need it now. We all have active income. We all have things that we could do for that cash flow. I'm deferring this as an investment strategy for later. So that's just a couple thoughts there. So if we look at the overall, let's create your own plan as step 2. What does this mean to you? You're going to invest what? Okay. And how long are you going to invest that? And what type of return profile are we taking? That profile also comes with risk. We got to consider what risk that looks like and be worth what at X date, 10 years, 20 years, whatever the case may be. Okay. So if we're assuming a 5% annual cash flow, which is very, very real when we look at a longer term trajectory, okay, your annual cash flow is going to be off of that net worth. And some people work backwards as far as how do I achieve this $27,000 a month, right? Because that was what will happen when you achieve this future value, this net worth. Maybe that pays your current employment, right? A lot of people look at it that way. If I'm making $27,000 a month now, Matt, I want to, in 15 years, not have to work that hard and make the same income that I'm making today later. So we can work this plan forward. We can work it backwards. We can achieve bigger numbers, smaller numbers. But I think at the end of the plan, it's great to have this net worth dollars. But what is that net worth dollars going to do for you? In this case, right around $6.5 million is going to have an annual cash flow of $329,000 for the year, okay, which is $27,000 a month. It's very important, very impactful for people. So create a plan, I think, that really speaks to you, but also that is real, I think is the most important thing to consider here. So if that plan is then going to make sense, and I'm just going through here to make sure I'm not skipping any steps. I still have paper with all this technology, believe it or not. Chrissy, I know you're rolling your eyes at my paper. Then the question has to be in your mind, okay, I understand, but Matt's talking about a high rate of return here. These returns are too high. Where are we getting these returns from? And for each person, it's going to be a little bit different, okay? But for all of us, it's the same buckets. So we have 4 buckets or 4 elements of return that we can consider when we're investing in real estate. Appreciation, we've talked about. Appreciation is very simple. We have 2 factors, supply and demand based appreciation. Okay, if there is a lot of supply, okay, not good. If there's a little amount of supply or the supply is constrained, that's very good. That's what we have here in the South Bay. And then we consider the demand. Is the demand increasing or is it decreasing? It's always increasing here in Southern California for a basic human need for people to live. It's also inflation based. So maybe your inflation dollars, are hurting in your savings account, but they're at work when they're put into real estate. So that's an important return to consider. Cash flow, also really important. Year 1 cash flow is not going to be the same as year 2, 4, 10. So I think it's really important to consider cash flow over a longer term period of time as opposed to your initial year 1. And I think that's where a lot of people, I don't want to say drop the ball, but a lot of people will overlook a deal or overlook a strategy because year 1's cap rate or year 1's cash flow is only this, or it's a slight negative to start out with. Well, if we hold on to that building for 10 years, is it going to be the same cash flow in year 1 as it in year 10? There's no way, not even a possibility. So I think when we look at cash flow, not only is it described as, okay, well, let's take our rental income minus our operating expenses, let's take out our debt service, but let's also zoom out on cash flow. What does it look like? Year 1 is important, no doubt, and compared to other year 1 properties in the area. But what does it look like in year 10, year 15, year 20 is also really important. And the thing that I always ask myself, and I try to challenge my clients and friends and family that I work with is, do you really need that cash flow now? Maybe, and that's important, but maybe not. Maybe you can defer it to another date. Also, what else do we buy in this market that is cash flowing? I see a lot of friends and family. I'm going to go buy that vacation, or there's no cash flow there. There's a lifestyle. I'm going to buy Bitcoin. That's a big one right now. There's no cash flow attached to Bitcoin. It's appreciation. You're hoping it's worth more later down the road, right? So I'll let you guys decide what's most important on the cash flow side, but all I'll suggest is let's zoom out on what that means to you. Okay, the big one, equity build up through amortization. That's a big mouthful. All that is saying is every time you pay your mortgage, you are also paying the principal of your loan amount down. Okay, so in the example, we started out with $200,000 down payment and we started out with a $600,000 loan. That loan amount is decreasing year over year because you're paying your principal down. Well, who's helping you or who's doing the work when they're paying the principal down? It's your tenants. Your tenants are paying you for a safe place to live for a place that you're going to maintain and give back to the community. And in return, they're going to work and helping you pay down the principal of your loan, which is an expression of return. I can pull that money out, or I could sell that asset and exchange it into something else. And that's a return that is quantifiable. Really important. If you're buying cash, like my parents, then this return would not make sense. It wouldn't apply. Okay, so something to consider there is paying down the principal of your loan, whether you're going to do it for 30 years or for the first 5 years and re-leverage, still is a return. Now, tax shelter benefits, we are not going to be your CPA for today or ever. That's not who we are, but we have plenty of CPAs that we can provide. But it is extremely important to consider the tax shelter benefits, especially if you're a high income earner, which I feel a lot of us may be in this room. It has been really important for me in my strategy and a lot of clients that we work with. You take your depreciation, you get write-offs on your interest and all these different things, right? But you can also accelerate those models. Instead of just taking year over year depreciation, most of these residential assets have 27 and a half years of depreciable life. That's according to the IRS. That's the way they look at them. I could take year over year, okay, whatever that amount is. They take the land value, they take the property value, they do their equations, and it comes out to year over year. Or I can accelerate all that into the first year or the second year of purchase, which makes a big difference for people. So that return profile will either be turned up or turned down depending on what you can actually quantify or what you can qualify for. And not everyone can qualify for full accelerated depreciation. So that's why it's a little bit different for each person. So if we take all of those returns, that's going to be your combined return, or going back to the equation, that's your R. And that's a way to measure what are we looking at when we're sustaining this R. Okay, so that R wasn't just cash flow. Okay, it wasn't just appreciation. It wasn't just paying down the principal or getting a huge write-off on my building. It's all of them. And doing it again in another building and taking that 4 units and applying it to that building. Now it's applied to that 8 unit, 16, so on and so forth. So I think when you consider all of these elements of return, which is very unique to most other investments, the return on equity positions that we were showing earlier, I think are very easy to achieve. They're not as far-fetched as you may think. So how do we come up with a big component of the return profile, which is appreciation? Okay. And this also goes into how is the market behaving right now? We just finished our 2025 study, so we're going to dive into it a little bit. If you can read this, I don't know how it's showing up on your screen. Again, technology is not my best friend. And if I'm squinting, I apologize. Squinting is a new thing for me. But the graph is starting in 1965, believe it or not. This is Buckingham's data. We have been collecting this since the 60s, okay? And this is all multifamily. There's no single family, no industrial. This is all apartment complexes. 2 units to infinity units, if there's such a thing, okay? And this is all localized. This is going to be basically Inglewood, imagine LAX, all the way down to Long Beach. This is going to be the greater South Bay, okay? And what we're looking at is a lot of different things. We're looking at a cost on a price per square foot on this axis, and we're looking at a year on this axis. And we're looking at also different market cycles. I will say the first thing that you need to consider is don't time the market. Please don't time the market. It is not about timing the market. It is about participating in the market. However, if I'm going to time the market, you'll notice we've been in a little bit of a slide the last couple of years. We have been down from the maybe inflated COVID highs, if you will. So it might be, if you are a market timer, and I won't judge you, it might be an interesting time to reconsider whether you're entering the market or you're refinancing and buying again, or whatever the strategy may be. Okay. But long-term rates of appreciation is what we focus on. Okay. That's the participation. And in this local market, you're at 16 and a half, 16.15, somewhere in that range, depending, because each quarter it comes out a little bit differently. But if we annualize it, that's what we're looking at long-term. Okay. So also market cycles, let's talk about them. I think it's really cool to play out some of these cycles. And Q4 market study is where this comes from. So each year we do a market study, and this is what it looks like. This is kind of the behind the scenes. If you're interested in something like this, we're happy to provide it to you as well. We do this for all of our clients and any of those who are interested. We publish these quarterly. So this would be Q4 of 2025. And this is the sample set. In this case, like I said, kind of LAX down to Long Beach. We're tracking all the number of sales. There's 263. We have the 4 major metrics as far as average cap rate, average GRM, average price per square foot, and average price per unit. Very interesting stuff. If you want to learn how all this works, I think we're going to do a couple more of these webinar series to actually dive into each one of these, because it's hard to cover every aspect of this within 45 to an hour, which, speaking of that, of course, I'm going to go over time. Sorry, Chrissy. But we're going to keep rolling. So this is what's done quarterly, and then it's projected in our annual study. And we also are going to look at what are these major metrics doing as far as trends. So we have a price per square foot, and we also separate it out between 2 to 4 unit assets, which is going to be your blue line, and 5 and up units, which is your red line. They're very different, mainly because of the financing, but you'll see they behave very differently, but they're similar trends. Okay, so you'll see that we had a little bit of a dip, a pretty big dip in the 5 and up space on a price per square foot, but it's already rebounding. Okay, interesting to consider. And the same thing is playing out when we look at the price per unit. Okay, same thing with cap rates and GRMs. So these are really good trends to consider, but cap rates and GRMs are all income based. So how is a price per square foot holding relatively stable in the 2 to 4 units? It didn't dip like it did in the 5 and ups. And I think that is the rents. That would be a consideration. Rents are continuing to rise in our local market, which is supporting these price per square foots, these price per units. Okay, but GRMs are down, right? As far as you're getting a really good deal on an income metric, or cap rates are up. We were in, the COVID era, we were down to like 3.5, and we're now almost up to 4.5, 5. I mean, pretty good pricing out there right now. So these are trends to consider. Other things to consider, what was happening in 2025, we saw a huge spike in transactional count. So everyone who was kind of sitting on the sidelines, or whatever the case may be, people are coming back to the market for multiple reasons. Maybe their loans are resetting and they have to participate. Maybe they feel more comfortable. Whatever the case may be, we are always going to look at some indicators, in transactional count or transactional volume is a really good indicator to look at. I always look at Long Beach as far as what's out there on the market. Half a year ago, there was about 90 plus listings in the 5 and up space. And looking at it today, we're down to like 42. So there's a lot of absorption, and that leads into transactional volume or transactional count. Another indicator that we're looking at is what's happening with the inventory, the supply. Okay. And what you'll see is we were really low in the kind of COVID era. I hate saying that, but that's just the truth. In 2021, we were down to 314 units. And we kind of peaked a little bit, at least in this cycle, up to 809. And we're down back to 574, which is pretty healthy when we look at the 60-year trajectory. This is just looking at from 2018, pre-COVID, when a lot of things were changing around that time. So if we're seeing the supply and demand starting to change, that may affect you. If you're an owner, hold it out. Your value is coming back. If you're a buyer, maybe it's time to get in before interest rates get lower and before buyers start coming in, and then it's harder to compete. So however that applies to you, like I said, we're just going to apply the data, and then you guys can try to fit it within your strategy. This is a really interesting couple charts here. I think it's not wise to time the market, like I said, but if we're going to look at some data, which I love to look at, Buckingham, again, has been here since the 60s. So believe it or not, Marty, still around, talks about some of these cycles. He lived through these personally. And what these are looking at as far as length in the depression, or length as far as pricing coming down, which is typically 3 to 5 years. Okay. And the depth of it, how bad was it? Okay. In this case, this is 1967 to 1981 recession cycle. It took 4 years. It dipped about 6%. And the recovery length, how long did it take to recover at its peak? 11 years in this case. And what was the recovery amount? $69. It's crazy to think about on a price per square foot, or 406%, which was about 16% year over year. Okay. We did the same for 1981 to 91. We did the same for 91 to 07. Okay. And 07 into 2022. So we're trying to just project how long these things are going to last. Okay. The down, how long is it going to take for it to come out? What is the percentage basis? What does it look like? Again, I know this is tempting to time the market, so go ahead and eat your heart out with the data, but I think it's important to just participate is the takeaway here. But maybe it's important for you to time the market, and maybe you need some data to kind of look at as far as, hey, is now a good time? We're 3 years into a slide. If we're 3 to 5 years on average, maybe 2026, at least our best guess, our educated guess, reading everything that we read and participating in the market, is it's going to be a little bit flat in 2026. And then we think that at the end of 2026 and 2027, if the data continues to hold out quarter over quarter, I think that's when a pendulum starts to swing from a buyer's market back to maybe equilibrium, right? Because that's all it does, is it's just swinging from one end to the other. So something to consider there, how that may be real to you. If you're an owner, I think you hold on. If you're a buyer, maybe it's time to get back in the market. Okay, so if we're getting back in the market, and the 2025 brief recap, because now I have to speed up because I was too slow in the beginning, and we're now looking at, okay, what financial options are we going to consider? 2 to 4 units, residential loans. That's why the graphs look a little bit different. People can still hold on to that. Please hold on to that 3% interest rate. You're not forced to sell. Okay. You have a lot of equity in your building. You're able to ride it out. 5 and up commercial loans, same asset, apartment building and apartment building, just different door count. Those loans reset. They're not 30-year fixed financing products. They reset every 3, 5, 7, or 10 years. So that's what we feel is when people were buying in 2020, 2021, maybe even 2022, their loans are resetting now, and they're kind of forced to reparticipate, which added a lot of supply, and that brought all the metrics down as far as being an owner. It's time to hold. All right, so let's go through it real quick. Residential products, you believe it or not, you can do 0% down. If you are a VA, thank you for serving, but you can get a VA loan. You can do an FHA loan. Okay, that's 3.5%, all the way up to 25%, which is your standard kind of out of the box conventional investment loan. So find what works for you. A couple things to consider. VA, really cool. You guys got the best loan products out there, but you can only do one at a time. So make sure that's a part of your strategy. You can't buy a duplex with VA and another duplex with VA and then buy your home. So there has to be some nuances that we consider. FHA, another great loan. I was able to do that a couple times on my first investment properties, but you're going to have to have the intent to live there. So consider that strategy and how that may or may not work for you. And again, you're only allowed to have one at a time. So my strategy was buy this 3 unit, buy this 4 unit. I know this is recorded, so I shouldn't be doing this, but have the intent to occupy it. And then my intent changed maybe within the first 6 to 12 months of owning the building. And then I was able to force a lot of equity by changing the rental roll, the rent rates. And now I refinance out into a 25% down residential loan, and I'm able to go do it again. I don't know, maybe you're not. I don't know who did that strategy, but maybe I did. But again, there's nuances there to consider. If you just want to put your 25% down and not have any nuances, very simple to do that. But the biggest piece here is some people just love 30-year fixed financing. They can afford the commercial product. The commercial product is cheaper on a price per door. You get $200 on a price per door versus $400 on a price per door, right? But some people just really like that fixed rate. You're not forced to do anything, okay? How it's underwritten. The underwriting for the residential loans is on you. It's on us. It's on the borrower. Okay. The borrower is most important here. What is your debt to income? What is your global calculations? The lender is looking at you. Okay. So some of you, that's great. Others, you're like, don't look at me. Okay. And if that's you, that's fine. We can look at the commercial loan product. The underwriting is much different. The borrower is less important and the property itself is most important. It's all qualified based on the building's financials, or potentially, if you have a market rents program, the future financials of what the building can do. And it's all underwritten under a debt coverage ratio. And we already talked about that it is adjustable rates. Okay, 3, 5, 7, or 10 years. So make sure you have a plan. Don't just buy a building. I like it. I saw it on LoopNet. And then your 3-year fixed term comes up and you're like, oh crap, what do I do? And then you give us a call. We'll help, but let's get ahead of that. And typical down payment options start at 25%. Depending on the deal and what the rent roll looks like, it might be closer to 35% or maybe even 50%. You also have bridge loans or private money loans. There's a lot of different terminology for that that can bridge you from a temporary situation into a longer term finance situation, but that's for another day. But those are going to be our financing options once we decide what we want, who we're working with, where we want to buy it, why we're doing this. Now, how do I apply the financing stack behind that? Okay. So different things to consider there. All right. So ownership strategies. Also with the financing, what am I doing? Okay. Am I going to buy a duplex in this example? These are real examples, by the way, of our clients where they're buying a duplex in Lawndale. Price was $830 in 2023. The gross rents were $44,000, just over. And the whole idea was to take this garage right in the middle and convert it into a third unit, an ADU. It was planned ahead of time. The building was purchased with all the math done, stress tested, tolerances up or down. Okay. And then our client was able to turn that duplex into a triplex. Very easy to do, very easy to exit. And he was able to sell for a decent price once he was able to turn it. And it came out really good. The units looked really good. The ADU, you may think it's a garage. It is a garage, but it comes out really nice if you work with a good team. And we're able to take our gross rents, $44,000, and juice it up to $90,000, and take a property that was worth just under $800,000 or just over $800,000, excuse me, and it's now worth $1,165. 2 years later, it's just under 2 years, but 2023 to 2025. Okay, so maybe the strategy speaks to you, right? You want to double your doors faster. You want to get on that exponential path quicker on the curves that we talked about, that return on equity. This would be in the 30 plus profile on that return on equity. But you got to understand the risks. There's going to be contracting involved. You got to deal with the city of Lawndale permitting wise. You may have to work with the tenants on maybe finding them a new location or moving them from the front unit to the back unit after it's remodeled. So there's a lot of nuances there, but you got to consider the risk profile when we're doing value add strategies. Okay. But if that's not for you, that's okay. I think turnkey is a great way to do it, right? Going back to the food analogy, it's brisket, low and slow. We're not cooking steaks, 2 minutes, toss, 2 minutes, toss, right? This is long term. And you can buy a triplex back in the day, believe it or not, 2018 is not too far, for $530. Okay. Not a lot of risk, really no money spent. We did a lot of performance for this client, all these expense ratios, expense profiles, followed up with them every single year. And there was no expenses for them. They were able to operate under the radar and didn't have to do any unit turns, really experienced no vacancies almost at all until when we're trying to sell it. This is a listing of ours where our client was buying for $2018, $530,000, and it's now listed on the market for $875. No work done at all. All they did was enjoy easy ownership. They self-managed the building, no unit turns, no value adding. And once the building became organically vacant, it was time to sell and re-leverage, which is what we're doing. So turnkey is a great strategy that can work for you. And I think that covers both ends of the spectrum. Okay. You can go full development. Don't recommend it when we're just getting started. Do the development on an ADU. That's the greatest way, I think, to, uh, I don't know, satisfy your appetite for wanting to be a developer. All right. So buying criteria. This will be our third takeaway. Make it real to you. Am I doing something turnkey? Great location. Tenants are already paying market rents. The maintenance is low, even though we're underwrite high maintenance. The maintenance you experience is low, right? But our scaling strategy is also slow, right? I'm not able to turn my 3-unit into a 6-unit in 2 or 3 years, right? It takes a little bit longer, a little bit less leverage. Okay. Or we're on the other side where value add properties, they need renovations, right? Tenants are paying below market rent, so I got to do something. And the political environment or the legislation environment may affect what you can or cannot do. A lot of work, a lot to manage, whether you're managing it or your manager's managing it, and you're managing the manager. Okay. But you can scale a lot quicker. You could take that 2-unit, turn it into a third. And in that case, that client was selling that 3-unit and he was able to buy a 6-unit in Long Beach. Okay. And so he did that in a year and a half, almost 2 years time. That's the scale. So there's no right or wrong reason or way to do it, but diving into quick metrics here, because I know I've gone over my time. So if you were still with us, thank you. We'll only take a couple more minutes of your time, but this is a great way and an easy way to consider how this may work for you. We do a lot of underwriting here. So this is just one piece of it. Okay. And we're happy to help you understand this a little bit more in detail, but simple ways to underwrite it are start with your initial investment. What is it going to mean to you, right? Maybe 300 is going to work. Maybe you buy this with a FHA loan and you put 5% down. Okay. This can apply to anybody, right? And then you want to consider your closing costs, what renovation budget, and quantify that total initial investment. What type of loan product are we looking at here? Okay, we just underwrote it for a client. That's why we're just showing it this way. They're going to look at 65% loan to value. Okay, and on the basic cash flow analysis, everyone has a different way to look at this. It's going to cash flow positive year one, right? It's going to cover your PITI. We had a client call it a pity. Oh, pity, I have to pay these things, right? It's your principal, your interest, your taxes, and your insurance. Right? That's your hard costs. That's what you're going to experience every month. Okay. So that's one way to look at it. And if that rings true to you, it rings true to me. Great. But other people, hey, I got to consider all the what ifs. Okay. So let's consider the what ifs. We have some repairs and maintenance built in. Maybe you are going to have some professional property management. Maybe you're going to cover some utilities. You're not going to put in some rub systems or other things. You're going to cover some of the utilities, pest control, gardening, licensing, you name it. We can go from a 60% expense ratio all the way to 40. We're trying to look at both sides of this, right? And then we can consider on the current rent tab, are we going to live in one of the units? Maybe we are, or maybe we're going to have the intent to. So we have to underwrite it that way. I don't know. Or are we going to look at just pure market rents? What is it going to get? And we're studios are 1,500. Okay, our 1-beds are 1,800, and our 2-bed easily can get 2,300 in this part of Long Beach. Okay, we run it through our annual operating forecast. We take the rents. We're going to back out some vacancy in the more padded or more conservative way to look at this. Okay, we're going to take into consideration maybe some parking rents, things like that, or garage rental. Okay, we're going to take those expenses, take out the debt. Okay, and maybe this is going to be a negative cash flow property for you in year one if you consider the spread. The spread is initial investment is going to be, or sorry, year one's investment is 271 on a monthly basis if I consider all the pads, or it's going to be a break even if I don't consider the pads. Okay, so that's where you guys got to decide, how am I underwriting these deals for me? Am I padding it to make sure everything's accounted for, or am I just looking at hard costs? And if you're going to live there, great. You can live in the 2-bed, 1-bath that would normally rent in the open marketplace for $2,300, and you can live there for $2,200 and own the building and pay yourself. It's like a forced savings account. It's amazing. Okay. So depending on how you're starting, have your team or have us reach out to us, and we can take a look at this and do a much more detailed analysis on what this will look like for you. Okay. But we're trying to look at both sides of the equation here. If you're living there, how does that look? Okay, if this is just pure investment, how does that look? And what type of investor are we? Are we going to be really conservative with our underwriting? Great, we have that. Or are we going to just look at hard costs? We have that too. And then if we look at year one combined returns, year two and year three, and we're just assuming our basic 5% appreciation, okay, this property now goes from 875 to over $1 million in year three, which is basic appreciation numbers. And we start at 16 and we get down to 14. Remember, our returns on a percentage basis are going to dilute. So maybe year three, it's time to refinance this thing and buy something else. So I appreciate everyone's time. This is all we have for today. I know I went over time a little bit. I do apologize. I get really excited and passionate about this stuff. But if this is interesting to you and you want to learn more, we got a couple options for you. We're happy to book a meeting, grab a coffee locally. You don't have to come into the office, okay? But we'd love to meet you if you're interested. If you just want to passively start and join our newsletter, just kind of start from afar, we're happy to help you there as well. This is the technology I'm not good with, but I think these things are called QR codes. So feel free to use the QR codes or not. I also have my email, my cell phone, whatever you need. But we do really appreciate your time. Thank you for spending it with us. And we're going to try to do this every other month. So if this is something of interest to you, and you want to come back, you'll probably see us in 2 months where we're going to take the basic concepts we talked about today and elevate it to the next step on what that looks like. And we want to continue working with you. And we just thank you guys for your time. So hope you guys have a great rest of your night. And we'll see you out there. Take care.
Thank you. Very much appreciate it.
Thank you. Have a great night, guys.